Okay, on inventories, there are two types of inventory system, which is the perpetual inventory system and the periodic inventory system. Yeah, so the perpetual system is whereby you have to record every transaction of your inventories. Then it means that whenever there's a purchase of your inventories, you're going to record, and whenever there's a sales of your inventory, you also have to record. All right, so the changes, the movement of your inventories is always in hand. So you have what we call an inventory account, so whereby you can actually know how much inventory you have in hand at any point of time. Right, so this perpetual inventory system is actually being used by big companies, all right, because it requires a lot of recording. It requires a lot of for example, they normally use the uh, scan of barcode, right? And in order for them to record all their inventories. All right. But again, go back a bit whereby we say that, oh, what is an inventory? Inventory is anything that, for example, you're talking about company that sell goods, yeah. So they have inventory that they are going to sell to their customer. So the idea of having this topic is actually looking at how you're going to measure, all right, and to recognize, one is what to recognize whether it's an inventory, and then how to measure your inventory. So coming to the measurement, all right, you have to look at what is the closing stock of your inventory. So in order for you to measure your inventory, that's how you have the system where we have the perpetual and the periodic. And the method for you to measure, right, you have four methods. One is FIFO, then you have the LIFO, first in, first out, last in, first out. Then you have the weighted average. And finally, of course, the unique one, right? The specific identification method, right? So whether it's a perpetual or it's a periodic, you can use any of the methods, all right? But again, for accounting purpose, once you use one method, for example, if the company adopts first in, first out or FIFO, then the company has to be consistent, right? So from year to year, they have to use the same accounting method, which in this case, FIFO, for example, right? So if you
Yes,
were,
you are
yes,
not presenting.
yeah, I have not presented anything. Thank you, dear. I am presenting now. I'm just trying to recap a bit on what we had covered on inventories. Yeah. We went through the period about the perpetual, all right, on the how to record. For example, you have the table where you have the date, the purchases, all right, and then when you make sales, how you record the sales of the, or in other words, we are what we call cost of goods sold. Okay. All right. So under the periodic, similarly, all right, you will have the same method, but the computation of your closing stock, all right, because remember that perpetual, you always have the recording of your inventory. So you do have a table that shows you at any point of time what is your inventory in hand. So that is your closing stock, all right, inventory in hand. But for periodic, all right, because it's more for company which is a small company that don't have a lot of resources, all right, they don't have enough staff to monitor the inventory in and out. So what they do is that they're going to apply periodic inventory system. Right. So, but the method for you to measure is still the same. It's LIFO, FIFO, or weighted average. You don't see the unique here because unit is very specific, which unit that you are selling, yeah, the specific method. All right, so under a periodic system, all right, inventory is not tracked in the accounting system continuously. All right, and then the beginning inventory balance is carried until the end of the period, and then you purchase, of course, you have to purchase your inventory. Right, but those purchases are accumulated during the period, and then at the end of the period, all right, you have your ending inventory. And how you decide on the ending inventory, you have to do a physical stock take. What do you mean by physical stock take? It means that you have to go close your business for one day and do the stock take. Anyone coming in? Okay, do the stock take. All right, this is an example of a perpetual inventory record where you have the recording of all the purchases. All right, what is your balance in hand, and then when there's a sales, what will be the cost of goods sold, all right, and then the balance at any point of time. So that's why we say that, okay, at any point of time, you want to know what is your closing stock, then you know, okay, as of 31st of August, you have 4 units in hand. So you have to decide the 4 units in hand here, what would be the cost of the 4 units in hand. So the cost will be depending on which method that you use, whether is it a FIFO, LIFO, or weightage average. Okay, if you look at here, the per quantity that you have purchased here is that you have on August 1st, you have 2 units. All right, and then you purchase another 4 units and 12 units. So total unit that you purchase is 16. But don't forget that you have opening balance of 2 units in the beginning, right? And then how many you sold? You sold 14 units. And if you look at here, all right, 16 units, but you sold 14 units. But why you have a balance of 4? Because remember, you do have these 2 units at the beginning of the period. Hold on, yeah. Okay, don't forget your right, your 2 units beginning. So 2 plus 16, you have 18. 18 minus 14, then that's how you have a closing of 4 units. So this is a perpetual. But when you do a periodic, you will not have these units in hand at any point of time. Right? The only way that you can know what is your closing balance is doing a physical stock take. All right. So you have to count how many units that you have. So if assuming that, let's say that you're now using FIFO, all right, the cost of goods sold include the oldest unit. So you know that first in, first out. So what you sell is the oldest unit. Your closing would be your newest unit, right? So you normally we use the same information given under perpetual. Then we ask you to compute what would be the cost under periodic, right? So how we know is that now we know that you are given the beginning opening balance, which is 2 units at 350, and you do know what is your purchases, how much you purchase. You purchase 4 units, all right, at 360, and another 12 units at 380. So that will be your purchases. So your opening balance plus your purchases is cost of goods available for sale, or sometimes called as a GAS. Goods available for sale, you have 6,700. All right, so how do you know your ending machinery? Ending, this is 4 units. All right, so how you want to decide? How do you know it's 4 units? Normally, under periodic, you will have to do a stock take. But using the same information in the table, all right, it says that, all right, you have how many units? You have how many? 2 plus, so have 18 units available. But when you do a stock take, you see that, oh, I only have 4 units left in my inventory. So if you have 18 units available for sale, but at the end you only have 4 units, so 18 minus 4, you know that this one is the 16. The one that you sold is 14 units. All right, again, right, you have 2 means that here you have 18, right? So 18 units. So if you have, when you do a stock take, you see that, oh, I only have 4 units in my inventory, in my shop, for example. Then 18 minus 4 means that you have sold 14 units, right? So the amount of cost of goods sold and any inventory are always the same for FIFO. So you see that FIFO, you have the same value for whether it's a perpetual or periodic, right? So that's how you decide on your COGS. So under periodic, if it's under perpetual, you do have inventory accounts. So you're going to debit your inventory and credit your accounts payable upon purchase. All right, and then when you sell, you are going to have two transactions. One is the journal for your sales. All right, your debit your account receivable, credit your sales revenue. And another one is that you're going to record the cost of goods sold, right? The cost of goods sold, which is the cost of the unit sold, the at cost, all right? Depends. What is the cost? Depends whether you're using FIFO, LIFO, average method. All right, so that will be your COGS. But under periodic, how you decide on the COGS is based on the ending inventory. So is the X value, the balancing. All right, so you know that what is your beginning, you know that how much is purchased, and then from there you get your goods available for sale, and then you do a stock take. We're doing stock take. Oh, I know that I have 4 units in my hand, so it means that if I have 18 units available for sale, but at the end I only have 4 units, then the goods sold is 14 units. Well, the cost depends. In the case, if you're using FIFO, the cost of goods sold must be the cost based on the earlier unit, right? So if I were to take 14 units using FIFO, 14 units it would be from the 2 units 350, 6 unit 360, and then I have 268, so another 6 units at 380, right? If you do that, right, will you get the same answer? 350 at 2, 360. So you're going to go cost of goods sold, right? How many units sold? 14 units. So the 14 units here, you have to take, okay, 2 units from 350, 6 unit from 360, and then the balance 8 means that you need another 6 unit from 380, right? Do you get that? So because you're going to compute the cost of goods sold. But if you want to compute what would be your closing stock, it means that you have 4 units. The 4 unit must come from 380, because first in first out, it means that the closing stock is the newest or the most recent purchases. So the 380 will be your closing stock. Are you clear about periodic so far? All right, so when you are required to do a periodic, you have to show this computation, right? You have to show the opening balance plus your purchases minus your closing stock, right? That's how you get cost of goods sold. So if you want to compute your gross profit, what would be the formula for your gross profit? Your sales minus your COGS. So whatever the sales means, that remember that sales is the unit sold at the selling price. So that's the difference between sales and COGS. COGS is goods sold at cost. Sales is goods sold at selling price. Can you see the difference between the two? Right, one is at the selling price, the other one is at cost. So when you want to compute the gross profit, then you have to decide what is your selling price. All right, the goods sold at the selling price minus your COGS, that will be your gross profit. Okay, this one is using LIFO, last in, first out, right? So under periodic, similarly, right, your cost of goods sold last in, first out. So it means that you're going to use how many sold? Just now you have 14 units sold. All right, so how are you going to decide the LIFO and the periodic? All right, the 14 units that you sold must come from the newest, right? So the newest must come from the 380, right? So now you purchased 12 units, right? 380. So your cost of goods sold will be 12 units at 380 and 2 units at 360. You get that? The goods sold and the last in, first out. You sold your the most recent purchases, which is 12 units. So 12 units you sold at 380, and the other 2 units you're going to take it from 360. Because it's a LIFO, last in, first out, it means that your closing stock, the 4 units left must be the old one. So you have 4 units, so it means that 2 units at 350 and another 2 units at 360. So that's your closing stock, yeah, 4 units. So that's the difference between your perpetual in terms of the computation. You always have to use this you have to use this what is it formula. Yeah. Okay, just take a few minutes. I hope that you can pray with me together that my daughter, I'm Sophia, who is actually now in a final year, first semester at IIUM accounting. She is sitting for her first ACCA paper at 2:30. Please, I hope that you can pray that she and her friends will do well in the examination. Okay, thank you for your prayers. All right, and then if you are talking about weighted average and the periodic, all right, how you decide on the cost per unit, all right? So the ending inventory and COG are calculated using the average cost per unit. So you see that your COGS and your ending inventory. So you only have to compute one time only the cost per unit. So how are you going to compute the cost per unit? You look at your cost of goods available for sale, right? So how many units available for sale? If you look at here, this is your COGS. Cost goods available for sale. All right, 6,700. So this 6,700, all right, if you in this case you're using LIFO lah, right? So here if using how do you get that? All right, it's the same whether you use FIFO or LIFO. Your cost goods available for sale is the same because it's based on your opening balance and your purchases. So your goods available for sale, you have 6,700 units, 1,000 ringgit or dollar here. And then for how many units? This one is 4, 12, and 2. So that is 18 units. So you get the average cost. 6,700 is the total goods available for sale divided by 18 units. So you get 372.22. Right, so that will be your per unit cost. So when you do weighted average and the periodic, this is how you do. When you want to compute what is your ending inventory, then you get the 4 units, which is the closing unit, times by the unit per cost. All right, so that will be your ending inventory. If you want to compute your COGS, it's similar. How many? The goods sold is 14 just now. You have 14 units times by 372, 14 times 372.22. You should get 4211.08. All right, so the average method for periodic is the easiest because you only compute one time, only your cost per unit, and then use that cost per unit times by your closing inventory, and that is also used for you to compute your cost of goods sold. Is there a question on this weighted average for your periodic? Anyone? Is that clear? Okay.
Yes, madam.
All right. Periodic, no running record of merchandise inventory is maintained. So whenever you purchase, you're going to debit your purchases account. Right, so there is no need to record an entry to inventory. So you don't have any inventory account. You do not have cost of goods sold account if you have a periodic. So whether you want to know whether the company is having a perpetual or periodic, all right, the tips that you look at into the trial balance. If the trial balance have inventory or COGS account, you know that there is a perpetual. But if the company in the trial balance, they have a purchases account, then that is a periodic. Is that clear? Right, in the trial balance, if they have inventory or COGS account, you know that there is a perpetual inventory system. But if you see that there's a purchases account, then you know that there is a periodic, right? Because under periodic, you only debit your, when you purchase, you debit your, where is it? All right, this one is when you make sales, all right? But when you purchase, you debit your purchases account, credit your accounts payable, all right? So upon purchase, you debit your purchases account. Why do I have to write purchases? Right? Okay, you have that purchases and credit your accounts payable. Okay, is that clear? Right. So when you make sales, remember under perpetual, what would be the journal entries under sales for sales? Shakila Nazir? What would be the journal entries for sales under perpetual? Shakila? Okay, Nurul Ain. Ada tak ada?
Yes, madam.
What would be the journal entries under perpetual where you make sales? There are two entries. What is the first one?
Inventory.
Okay. Debit. Okay. When you make sales under perpetual, the first one, inventory, you nak debit or credit?
Inventory credit.
Okay. Debit.
Make sales.
Okay. Debit what?
Cost of goods sold.
Very good. You debit your cost of goods sold, credit your inventory. So that one to record your COGS. The other entry to record your sales. When you want to record your sales, debit your accounts receivable, credit your sales revenue. Can you get that?
Okay, madam.
Okay, Omar Ashraf.
Yes, madam.
Okay, repeat. When there's a sales under perpetual.
When there's a sale under perpetual inventory, we credit inventory and then we debit cost of goods sold.
Okay, the second one.
What was this? Second one?
Yeah, there are two entries kan. One is to record the COGS, the other one to record sales. So how you record your sales? Baru sebut.
Account receivable.
Yeah, very good. Debit your account receivable, credit your.
Credit your credit. Another one is, what was it, madam?
Sales.
Yes.
Hai.
Okay.
One to record sales, the other one to record COGS.
Yes.
Okay. So that is under perpetual. But under periodic, remember periodic is simpler. So it means that there only one entry. So you're going to debit your account receivable and credit your sales revenue. Why you don't have to debit your COGS and inventory? Why they don't have the second entry under periodic? Ilham. When under periodic, there will only be recording of the sales, right? You don't have anything on COGS and inventory because under periodic, you do not maintain COGS and inventory accounts, right? You do not have to have that COGS and inventory accounts under periodic because how you decide on COGS is later based on your stock take. Right, so you have to work backwards. So that's why under periodic you only record the sales transaction. Okay. The periodic inventory system requires calculation of the cost of goods sold. At the end, the company combine number of accounts to compute cost of goods sold for the period and shown in the income statement. So these are the things. All right. We do have the purchase returns and allowance, purchase discount, but I do not cover that. All right, and then whenever there's a freight in, all right, that will be also part of the purchases. Cost of goods sold, goods available for sale minus inventory. All right, no adjustment is required for inventory shrinkage. So remember, perpetual, all right, you have to record the inventory, and then of course, perpetual also required to do stock take to make sure that goods in hand is similar to what is in the system. But remember that goods in hand sometimes subject to shrinkage, subject to expiration, right? Subject to shrinkage, It could be broken, for example, so you have to do a stock take, right? And then if you see that, okay, your stock take shows that the goods which is good for sale, all right, it means that what is in good condition is lower than what is in the system, then you will have to do a adjustment. Yeah, so you're going to credit your inventory, debit your COGS. So that is again under perpetual. But under periodic, you don't have to do that because you do not maintain your inventory account and you do not have any COGS. Whatever is left at the end of the day, all right, when you do the stock take, that will be your closing stock. And this only take the one which is good one, right? Okay. All right, I think that we have covered this. All right, any other issues that you want to know about your inventory before we go into financial assets?
Everything's clear, madam.
Clear, yeah? All right. This is have we gone through the inventory? We have, right? The ratio. But later, all right, we do have one topic on the financial analysis, right? So, but because this topic is on inventory, it talks about how we use the inventory information in order to make a decision. Yeah. All right, we have gone through this also, I think, the overstated, all right, so it's done. Okay, you are going to have your group exercise on Thursday, yeah? Just cut. Okay. So the next one is I want to look into mana I punya inventories. All right, this is the right chapter on internal control and cash, right? I'm using this from Hongren. This one is Pearson Hongren, huh? Yeah, I'm looking at where is the these are all the internal controls to cash receipt. All right, so because there are too many, right? These are all, you see, you have 63 slides. I cannot go through 63 slides in a class. Where is the bank reconciliation? Control device, bank, here only. In 49, only masuk bank reconciliation. Right? Okay. Yeah, everyone listen to me clearly, yeah? So this bank reconciliation is normally being tested. I think that will be in the final exam, right? Your bank reconciliation. But the topic before this, all this control of your financial asset, right, normally it will be tested in the objective question or in a short essay, right? So you have to know about the internal control, and the bank reconciliation will be a question on its own. Is that clear for your final exam? Okay, then is bank reconciliation, how to prepare. Okay, I think that I will not go through bank reconciliation today, maybe, right? Because I think I should go through the first part, but it's very, apa nak buat ni, banyak sangat ni. It's too many here. Right, internal control and cash. So this is chapter 8, right? Looking at how you want to control. What is the internal control, and then what are the components of internal control and control procedures. So it's very important, all right, even though it's not only theoretical, but in practice, a company must have a good system of internal control, all right, in order to make sure that okay. Right, the asset are being monitored, or you don't lose your asset. Yeah, apply internal controls to cash receipt, apply internal controls to cash payment. So this one is very important, even though you are not working right now, but you must have this idea because later when you do audit, for example, right, you should know what are the controls, internal controls taken by companies right, to protect their assets. Right, what are the journal entries when you have a petty cash? All right, explain journalize when you have a credit card sales, use of bank account, and then use of cash ratio. Okay, so this would be the LO1. Okay, let's see what is the internal control. Internal control is the organizational plan and all the related measures adopted by an entity to safeguard assets, encourage employees to follow company policies, promote operational efficiency, and ensure accurate and reliable accounting records. So you see that the internal control is a system itself, right? It cannot be on its own, right? It needs an help from all other section, right? Of course, the objective is to safeguard your asset. How can it be used? Right, is the plan safeguard asset, encourage employees to follow policy, promote operational efficiency, and ensure accurate label. So this is what we read just now. All right, we do have this very important, the internal control and the Sarbanes-Oxley Act. Right, this one is in the UK. The Committee of Sponsoring Organizations, provides thought leadership related to enterprise risk management, internal control, and fraud. For public companies, companies that sell stock to the general public are required by the US Congress to maintain a system of internal control. Right, and then Congress passed the Sarbanes-Oxley Act. I think maybe this one UK, US or UK, yeah, SOX. To address public concern about various accounting scandals, SOX requires companies to review internal control and take responsibility for the accuracy and completeness of their financial reports. All right, remember financial accounting is all about money, right? It's all about monetary values, all that. So this is why it's very important to have the internal control. All right, so a public company in this one is under Sarbanes-Oxley Act, right? A public company means that a company that issues shares to the public must issue an internal control report, which is report by management describing responsibility for and the adequacy of the internal control. And then auditor must evaluate the internal controls. And then you also had the Public Company Accounting Oversight Board oversees the work of auditors of public companies. Accounting firms are not allowed to audit a public company and also provide certain consulting service for the same client. All right, state penalty awaits violators 25 years in prison. So in this case, how we say that, okay, accounting firm in Malaysia, you cannot have the same client for more than 5 years or 3 years. I'm not sure, yeah. So after 3 years or 5 years, you have to change your auditor. Right? Company cannot have the same auditors over a long period of time. Right, so the component of internal control, we have control procedure, risk assessment, information system, monitoring of controls, and environment. Right, but the acronym is CRIME, right? So CRIME, C-R-I-M-E. Internal controls monitored by internal auditors and external auditors. So we have two types of auditors. One is the internal, the other one is the external. Internal is actually employed by the company. They are the auditors. They actually look into the internal control. All right. The external auditors are the one paid by the company to do audits. All right, separation of duties, which is a division of responsibility between two or more people to limit fraud and promote accuracy of accounting records. All right, so for example, we're talking about handling of cash. You cannot have the same person doing 2 different or 3 different tasks related to the cash. All right. Separate operations from accounting and separate the custody of asset from accounting. So the one who do the recording of cash must not be the same person who actually hold the cash, right? Custody of asset. So if you have the same person, I have the money, I'll also do the recording, all right? The possibility of fraud to happen is very likely, Right, so that's why you need a separation of duties. For audits, in this case, say that internal audits are performed by employees of the company, external are performed by independent auditors. Right, so you are going to look into the documents as well as the electronic devices. E-commerce, all this lah, nanti you baca lah bunyi. So if I were to keep reading this, all right. So how are you going to have a control over your cash receipts? Let's look into it. Cash receipts occur primarily when a business sells merchandise or services. Each source of cash has unique security measures. A receipt of cash over the counter in a store involves a point of sale terminal, POS. All right, so we have cash register. So whenever you receive cash, you see that the workers will key in the cashier, for example, how much received, what is the sales, and how much cash that you receive. So this is the point of sale terminal. All right. But many companies receive checks by mail in payment for service or merchandise. So sometimes payment by the accounts receivable, not only now, all right, there are not so many actually using check, right? Because now we have the online banking, right? And then, but still there are several controls are needed for cash receipts. Yeah. For example, if you receive check by mail, right? The check will go into the mail room. All right, and then the treasurer will have to record whatever checks that receive, and then deposit ticket, and then you have to bank into the bank the check. Yeah. Remittance advice has to be issued upon receipt, and then goes into the accounting department. Total amount posted to cash, and then you have a controller there. Yeah. Okay. A lockbox system, where customers send their check to a post office box that belongs to a bank. A bank employee empty the box daily and record the deposit into the company's bank account. Right, so we still have this system, or even in Malaysia, but I don't think many companies are still using the check now. Right. Apply internal controls to cash payment. Company make many payments. So when you make payments, all right, a check provides a record of the payment. A check requires a signature by an authorized official. So normally you need more than 2%, more than 1%. Yeah, supporting evidence is verified prior to the check being signed. Right, controlled payment by check, all right, in order to make sure that the payment is made for the right purpose. All right. So you have purchase order, you receive your purchase order, and then you receive your merchandise, and then the seller will issue an invoice, and then you make payment based on the invoice. Yeah. Right, you receive the goods, and then only you make payment. Right, the paying only for the goods received and authorized, and you pay the correct amount. Don't pay more than what you should. Right, okay. Okay, it's common. So all this why we do have bank account, right? So bank account means that everything is in the bank. But normally company will also have what we call a petty cash fund, right? That is used for in order for companies to make payment for small or miscellaneous item, right? It's used as an in-office source of cash for small immediate purchases. It's often the responsibility of a designated employee to handle the petty cash, right? Petty cash tickets serve as authorization for payment. So company also have what we call a petty cash. Right, normally what you use for petty cash, use for purchase of office donuts, for example, to buy cleaning supplies, all right, to buy sympathy flowers, all right, to entertain your clients, public transportation, and tips for service providers. So that's why they need. So whenever the company is making use of the petty cash, all right, there must be a recording of the use of the petty cash, right? So it will mean that you're going to create a petty cash, debit your petty cash, credit your cash. So this one is to create, right? Create a petty cash fund of 200, right? So when you get the 200, you get it from your cash account, yeah, and then put into a petty cash. So whenever there's a payment, right? Petty cash payment. Then they have a petty cash ticket. That means that it's just a memo. They have to write what is it for, all right? And then who authorized the payment, who received the money, right? So an impress system is a way to account for petty cash by maintaining a constant balance in the petty cash account. At any time, cash plus petty cash tickets must total the amount allocated to the petty cash fund. So whenever the petty cash reduce, we'll top up the petty cash account. Right, so petty cash, all this, right? So whenever you use the petty cash, it means that you're going to record debit your expenditure. This one is to replenish. When cash is missing, the cash short and over account is used to record the unaccounted for amount. All right, the unaccounted for amount. Right, we use the journal entries to record any there's a cash short or over. So if it's cash short, it's an expense. If you have cash over, then it's not a revenue, but means that you have to record it somewhere. Yeah. All right, credit sales recorded. So when you have a credit sales, remember that you're going to receive credit card expense. How okay, this one is not credit sales, credit card sales recorded. Right, Smart Touch Learning sells merchandise inventory to a customer for 3,000 on August 15. Customer pay a third-party credit card. The process assess a 4% fee and deposit the net amount. So the entry that you need to do mean that your sales is 3,000, but what you get is less than that. Because why? Having a credit card, the company has to pay a certain fee to the bank, right? So money. Okay, so that's why you get 120, you have to pay to the bank. So that's why in Malaysia, some companies, smaller companies, all right, smaller seller, they do not want to pay to receive payment by credit card, right? But I think that now, or with all the e-wallet, online banking, they prefer, right, non-cash transaction, right? But the credit card, sometime last time when we say that, okay, a smaller company, they don't want to receive because they have to pay the 2% to the bank. All right, so when you record, you still have to record the 3,000. All right, credit card expense, take out from your cash, control device. Okay, remember that you still have to, okay, this is just to show you how a remittance advice look like. So we give you the details of what it is, and the payment is for the purpose of California office products. All right, the value is $300. All right, a bank statement. Okay, now 248. A bank statement, all right, reports the activity in a customer account. So it's common that for company to have a bank account. So every month the bank will issue a bank statement. So now the option is that for the company to have a manual, the printed bank statement, or they can have the PDF one, right? Rather than being sent every month the bank statement, so they can have the PDF one, right? It reports the activity in the customer account, issue the accounts beginning and ending, and it lists the month's cash transaction conducted through the bank account. So you're going to see the debit and the credit. Right, the cancelled checks are the physical or scanned copies of the maker's cash checks. Right, cancelled check. Right, this is an example of, in this case, Valparaiso's bank statement. Right, so you have the deposit. So now, right, if you look into, you do have a bank account. For example, students have a bank muamalat. You do actually receive the bank statement every month, isn't it? Or if you choose to receive online, then you receive the PDF, right? But of course, it's not similar to this, right? You see that ours is a lot more. Not, you don't say deposit. Deposit, they put a coding, yeah, a coding that tells you what the codes means at the back of the bank statement. Right, if you see here, you have the deposit, and then you have EFT, collection from customer. It means that the customer pays direct to the bank, right? Rather than pay to you, the customer pay direct. So this one is very common when you have the online banking now, whereby the customer will pay directly to your bank account, and then you don't actually receive it in your account, but you receive that in your bank statement, right? Then you do have these service charges, $20. But remember that you do not, this service charge is actually deducted from your bank account, right? So you see that later, your bank account and your bank statement, or bank account is the one that you record your bank transaction based on the journal entries, right? But your bank statement is the one recorded by the bank depending on the transaction that involve the bank. All right. So for example, the service charges of $20, all right, you will have that in the bank statement, but you don't have the service charges in your bank account because unless you receive the bank statement, then only you know, oh, there's a service charge of $20, right? Similarly, checks, for example, checks 202, 201, 200 are the checks that is cleared by the bank, right? So what it says here is that company will issue a check to their accounts payable, right? Means that when you want to make payment to your accounts payable, you're going to issue a check, right? So you issue a check, for example, issue a check number 200, the amount is 1920. So the check will be sent to the accounts payable. And when the accounts payable bring the check, they have to bring the check to the bank in order to cash out. So they have to bring the bank check to the bank. The bank will have to check the check, right? Whether the check is correct or not, right? Whether there's no fraud, whatever signature is there, the amount is correct, all that. So if everything is okay, then the bank will pay the accounts payable, right? Your supplier, for example. All right, and then only the bank will record in your accounts. But sometimes, all right, remember when you issue the check, your bank account you already have recorded, right? Then you give the check to the supplier. But sometimes supplier do not bring the check immediately to the bank. They will keep the check first because normally check will only expire after 3 months, right? So maybe here is statement April 30th. So, but the supplier will only bring the check to the bank somewhere in May 2019. All right, so whenever he brings to the May, so it will not appear in your April, but you have recorded your cash payment in your bank account, right? So remember, there are two different balances here. One is the one in the bank statement, the other one is in your bank account. So you record the bank account depending on your cash receipt and cash payment. Bank will record based on the amount that received by the bank and the amount paid by the bank. Yeah. So they will see that's why later you have to do a bank reconciliation. Why? Because you have to reconcile the balance between your bank statement and your bank balance here, all right, to make sure that at the end of the day you are going to have the same balances. All right, you reconcile the statements. All right, this is what we call EFT, or the online banking, where you transfer cash by electronic communication rather than paper documents. All right, now we have a lot being paid online. Right, it's less expensive than mailing, and debit card and direct services are also EFTs. Right, sometimes you make payment by card, so that is also EFT. All right, bank reconciliation is a document that compares and explains the differences between your cash on the company's book and the bank records. Right, you have company books and then you have the bank records. Differences arises because of time lag in recording transaction called timing differences. Right. Example just now, all right, in your company's book, you have recorded credit of the payment for your supplier, but the supplier has not bring the check to the bank. All right. So in April, you have recorded the payment, but the bank has not actually cashed out the check. So still in April, you will not see that payment yet, yeah, in the bank statement. So preparing the bank side of the bank reconciliation, the bank side of the reconciliation includes deposit in transit that are recorded by the company but not yet by its bank. So what we have here is that deposit in transit is what DIT, right? It means that company has made deposits, right? Or in other words, we say that company have recorded the deposit, the receipt of cash in their company's account, but the bank, right, has not actually received the money. Yeah, deposits. The bank has not received the deposits. Why? Because of timing differences. But outstanding check is that the company has issued the check, so they have credited their bank account. They have actually issued the check, so when they issue the check, they have to record that in their books, so they are going to credit the cash account. But the check, right, which is issued to the supplier has not bring the check to for cash out. So the bank will not have this recording of the outstanding check, right? So you will only know the differences on the deposit in transit and outstanding check is when you compare your bank statement and your cash account. And then we also have bank errors that either incorrectly increase or decrease the bank balance. All right, on the preparing the book side of the bank reconciliation, so you're going to have two. One is the bank reconciliation from the bank statement balances, or you can prepare from your cash book balances. Yeah. So the book side of the reconciliation includes credit memorandums, all right, which are cash receipt by the bank. Cash receipts by the bank has received and recorded, but the company has not recorded on its book. So it means that the payment is made direct to the bank received the deposit, but the company has not recorded because they are not aware of the transaction, right? Especially when you have the electronic fund transfer and then the service charges, right, we put as debit memorandum. So for the bank, all right, when you see credit memorandum, it means that it's a deposit to the company, right? A debit memorandum, it means that it's a charge to the company. Why is it credit to the bank? Credit because it's a liability to the bank. Why? Because the money does not belong to the bank, the money belongs to the company. Right? When it's a debit memorandum, it means that it's a charges which is charged by the bank. So you're going to debit your expenditure or your cash, right? Interest revenue on a checking account in non-sufficient fund check, all right, which are received from customer for payment of services rendered that have turned out to be worthless. It means that, all right, when you issue check, all right, and the company, the supplier will bring the check to the bank, and then the bank say that, oh, I'm sorry, I cannot cash out the check because the company do not have enough fund. Right? So it means that, for example, right, what the balance in the account of the company bank balance is 10,000, but the check is for 20,000. So of course the company, the bank cannot cash out because you do not have enough balances in your bank account to cash out the 20,000. Your bank balance is only 10,000, but your check here is 20,000. Of course, the bank will not pay that 20,000. Book errors that either incorrectly increase or decrease the cash balance in the company general ledger. Right. So for the bank reconciliation, all right, the reconciling items on the bank side, you only have the deposit in transit and outstanding check. You can have errors as well. Right, on the book side, you have the EFT receipts from customer. So, okay, this one is only an example, yeah. Reconciling item, deposit in transit, April 30th, you have 9,000, and you also have outstanding check of 2,000. On the book side, you receive EFT from customer 100, interest revenue earned on bank balance, bank service charge, EFT payment. Okay, so all these actually, all right, how do you get that information? So the book side, this information is actually from the bank statement, right? This information is actually from the bank statement. And this information is actually from the cash book, right? It's from your cash book. So look at that. You have information from the bank statement that you have to reconcile in your cash book, and you do have the information from the cash book that you have to reconcile in your bank statement. Okay. So remember, you have to understand what is the deposit in transit. It means that company has issued, received money, right, which is directly received by the bank. So company have not recorded that. So now you have to do that later, right? The outstanding check is the one that is issued by the company. Salah. Okay. Correction. Deposit in transit means that the company has received cash, but the money has been banked or deposited into the bank account. Yeah. Outstanding check is the company has issued check, but the check has not been presented to the bank. Right. So this is the bank reconciliation. You have two sides. One is the bank side, another one is the book. You can do a side by side, or you can do a vertical where you do the bank balance. You start with the bank balance, all right, and then later you look for the book, all right. So the bank balance, right, is given that the bank balance is 12,720, and then you add on your deposit in transit, and deposit in transit is added because that one will increase your cash balance, right, your bank balance. And then you minus outstanding check which has not presented to you, all right, then you should get an adjusted bank balance here, right, 90. So initially bank balance is 12,700, but you add on your deposit in transit, right, 9,000, and you minus your outstanding check. Now the adjusted bank balance should be 19,720, right? But the book, it also has to be reconciled, whereby you book balance initially it was 2850. Then remember that the information provided that you have all these from the bank statement. So you're going to add your receipt from your customer. All right, interest revenue earned on bank balance. This is also a debit, right? Addition. Bank service charge is a deduction. And then payment of water bill of 40 is a deduction. And you also have not sufficient check. So not sufficient check, all right, initially you have credited your bank or your cash book, but because of NSM, you're going to debit it again. So look at this, all right, you add. So you have what is added is anything that will increase the cash of the company. So EFT received from customer is the amount that received from your customer, means that customer credit directly to the bank. So now you increase your cash balance. Interest revenue is also increased, all right, so you add that. But the expenditure, for example, the service charges, your water bill, which is EFT payment for your water bill, means that you have a credit instruction or a debit instruction, and then not sufficient fund is also the minus here. Right, again, not sufficient fund. Why is it minus? Anyone can help me why you minus your not sufficient fund? Check.
I think because first when receive the check, we debit because and then
in this case means that we actually receive the check from the accounts receivable from your customer, isn't it?
I think so.
So when you receive the check from your customer, you're going to debit your account, right? But when you bring that check to the bank, it seems that the customer do not have enough money. So that's how the bank rejected. So that's why you have to minus in your account. Yeah, so the bank have not deducted any amount, right? But you have to amend your cash book because initially when you receive the check from your customer, you already have debited. You debit your cash. Yeah, your cash book, you debit your cash because you receive from your customer. But when you bring the check to the bank, right, it turns out that the check is an SF check. So it means that the customer do not have enough bank balance to pay for the check, right, to cash out. So because of that, you have what we call NSF. So now you have to contra, right? Initially you have debited, now you have to credit your bank account, right? So that's why you minus 1,200. So once you do all these adjustments, you see that your adjusted book balance now is 19,720, which is the same as what is the adjusted bank balance, right? So what it says that now because you do the bank reconciliation, your cash book and your bank balance are now the same, right? The adjusted book balance and the adjusted bank balance must always be the same. All right, you must agree, means that you have taken out whatever information which is not taken by any of the other bank or the book. Any question on this example?
Madam,
Yes.
I want to ask, do the NSF check is the same like what we call check turn down?
Ya, betul.
Oh, okay.
Yeah,
Thank you, madam.
insufficient fund. NSF non-sufficient fund check. So that's why it can be from both sides lah, right? So if in here you see that NSF because you receive the check and then you bring to the bank, but the bank cannot cash out. All right, where you receive the check from your customer, you already debited the payment. You debit your cash, credit your account receivable. Remember? All right, when your customer make payment, but in this case, rather than pay cash, they give you check. So you still debit your cash book, credit your accounts receivable. But when you bring the check to the bank and the bank say that, oh, I'm sorry, I cannot cash out the check because why? Because there's not sufficient fund in the accounts receivable. So because of that, you have to contra the payment, right? So now you are debited. Now what you do is you credit. Bila you credit, that's why namanya is called less, right? Because credit will reduce your cash book, debit will increase your cash book balance. Is that clear?
Yes, thank you, madam.
Mm-hmm. Right, you are expected to do a bank reconciliation, yeah, in your final exam. There will be one question on this. Right, so I hope that you can score on this question, full marks. Yeah. Right. Summary of the various reconcile item. Bank balance always add deposit in transit, subtract outstanding check, and add or subtract corrections or bank errors. So it depends on the correction whether it will increase or decrease the bank balance. Book balance always add bank collection, interest revenue, and EFT receipts. Subtract charges, NSF check, and EFT payments. Add or subtract book errors. So these errors, right, students is the one that students normally find confusing. Right. Bank side of the reconciliation, the beginning has 12,720, then you add your deposit minus your outstanding check, and then you have the adjusted bank balance, right? And the book side is the one that you add and minus just now. You add your EFT receipt from customer of 100 not recorded in the cash account. So now you add to your book balance. Interest revenue is the $30 deposit on the bank statement for interest earned not recorded in the cash account. Now you record, you add to your book balance. And the service charge, right, is in the bank statement but not recorded in company account. But remember that service charge is an expense, so that's why it is subtracted from the book balance. EFT, what is this? EFT payment, right? If it's a payment, EFT payment, then you're going to minus, right? So this one is subtracted because it's an expense. Not sufficient fund from a customer on the bank statement, amount is subtracted from the book balance. So after reconcile both the book balance and the you will have an adjusted bank balance and the adjusted, which is the same as the adjusted book balance. Right, and on top of that, you still have to reconcile. So the one that you do a journal entries are the one, all right, the one that is not in the, which is actually the one here, right? The book side here, all right, is the one that you have to do journal entries. This one, deposit in transit and outstanding check, is already in your accounts. It means that you have already do the journal entries. But the one which is in the in the bank statement, you have not recorded that. That's why you have to do the journal entries. All right. So the journal entries here, you debit your cash for your account receivable. This is the one that is collected by the bank. Right, debit your cash, and then interest revenue is a revenue. Debit cash, credit your interest revenue. Bank expense, all right, this one is an expense. Debit, credit your cash. See, it's a credit there. So that's why you minus, all right? This one is subtracted from your balances. Utility expense, again, is an expense. Then why is it subtracted from your cash? Account receivable, this is an SF, right? An SF. So you see, you debit again your account receivable, credit your cash. Initially, all right, when you receive the check from the customer, you debit your cash, credit your account receivable. But because the check is NSF, right, it seems that you have to contract, right, as if nothing happened. So you contract the transaction. Record again account receivable 1,002 means that the account receivable still owes you 1,200, and cash you're going to credit because previously you have debited your cash account, right? Journal entries posted to T account. So first you have to do this and then you post it to T account. That's how you're going to get your balances here, right? Initially it was 2850, and then you do this transaction, you see? But this is the amount, right? Is there 4 transactions there? 1, 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Why? Okay, let's see again. In the bank statement, 1, 2, 3, 4. Oh, other 5 at see, right? So you have 1, 2, 3, 4, 5. So this is actually the one that you have to do in your bank. Yeah, adjust your bank account or your cash account. So the closing here will be the same as your adjusted bank statement balances, right? And finally, we have this ratio, cash ratio, to evaluate business performance. How do you know whether the company is doing okay or not? Based on the cash balances, right? How can the cash ratio be used to evaluate business performance? Right, the cash ratio helps determine company ability to meet short-term obligation. It means that whether the company will be able to pay their short-term liabilities. Yeah, so what we call it as a cash ratio. Right, what is a cash ratio? Your available amount of cash plus cash equivalent divided by total current liabilities. So in other words, you want to see that how much cash you have and how much is your current liability. All right, if your cash is more than your current liability, you are doing okay. It means that it has to be more than 1, right? So your ratio must be more than 1. So your cash must be more than your current liabilities. It means that you are able to pay for your short-term liabilities, right? Why short-term? Because here we are looking at the current liabilities, not total liabilities, is the current liability. That's why meeting your short-term obligations. Yeah, so cash equivalent are highly liquid investment that can convert it into cash in 3 months or less. So for example, if you have investment in a market, right? For example, you have shares in a market where you can actually liquid the shares, all right, within 3 months, then we have that, we call that as a cash equivalent. Yeah. So if your cash ratio, you have a good cash ratio, it means that that is also good for the company. But if you have too much cash, it's also not good. Yeah. We have cash equivalent, and total liability. So we have 2016. Look at the performance of company, 2015 here, and now we have 2016. If you look at the cash ratio, all right, you have 0.49 and here is 0.26. Which one is better, 2015 or 2016? Which one is better for the company, 0.49 or 0.26?
2015.
Yeah, we want cash ratio, the higher is the better. right? It means that, but it's still not good, right? Why? Because your total current liability is 2859, which is more than your cash ratio, right? But here it's worse because your liability is a lot more as compared to the cash. So it means that, in other ways, saying that company is actually not able to make payment of their short-term liabilities, right? They have to struggle a bit in order to meet the short-term liabilities, right? If you have a cash ratio of 1 point something, right, anything which is more than 1 means that the company has extra cash, all right, to meet their short-term liabilities. Does that make sense? Oh, what's this? Oh, finish already. We only have the cash ratio. Right, so we have covered. So remember that the first part of the slide, I do not cover everything because it's too theoretical, but you have to read the internal control, because normally the question will be as an objective question, or it could also be a short answer, right? But the more important, the practical, the computation side is on this bank reconciliation, whereby you have to do the bank rec, right? Reconcile the bank statement and the cash book balances, and then you have to do the journal entries, right? And then you have to update your cash book balances as well, right? Show the transaction in your cash book. Right? Question? Okay, so later I will put in the classroom the the tutorial for your bank reconciliation, right? So before you do that tutorial, please prepare yourself for the group exercise on inventories first, yeah? So any question on your inventories before your group exercise? I think that carries 5%, right? It's a group exercise, so hopefully you will help each other to come up with the best. I hope that everyone can score full marks for the inventories. There's only one question, right? One main question, main question, right? Of course, there are sub questions to that.
Madam, what is the time limit for
1
the?
hour.
Oh, okay.
It will be during the class time, yeah?
Madam,
Mm-hmm.
we can use Excel for it?
Yes, can.
Okay, thank you.
Or should we all use pen and paper? Can I request you to use pen and paper only?
Can, madam.
Can. So can we agree that everyone use pen and paper only?
Yes, madam.
Yeah, so okay, pen and paper only. Fatihah?
Okay, madam.
To be fair, yeah, so that everyone will have the same time given, everyone will answer the same way, for example, and easy actually. Okay, so any question before we leave? Don't forget your attendance form. And if you don't have anything else, I think that's all for today. I hope that you have learned something or something new, if not a revision to you on your bank reconciliation. I hope to see you again, inshallah. On Thursday, you're going to have your group exercise first, and then only we look into tutorial of your bank reconciliation. Right? We do together the bank reconciliation, because I think you don't have time to do the bank rec because you are preparing for the group exercise. Okay.
Madam,
Yes.
can you share the slide?
Yeah. I will put it into the class because I have not gone through the slide before the class. So that's why I will share the one is the slide. The second one is the tutorial question on bank financial asset. Okay.
Thank you, madam.
All right. So with that, I think that's all. I see you again, inshallah, next class with that. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam. Thank you, madam.
Thank you, madam.
Thank you, madam.
Thank you, madam.
Madam.
Yes.